All right, welcome to another video. We're going to be dealing in this video with a couple of things, and we're going to be doing that using financial statements effects template, some journal entries, and T accounts. What a deal. So there are a couple of different types of dividends companies will pay, and there's actually more than that, but usually dividends are going to fall into one of two categories. We're going to talk about cash dividends, and we're also going to talk about stock dividends. And there are some, we can pay dividends in property. That's just generally not done. However, cash dividends and stock dividends are quite common, so we're going to look at those. So the first part of this in requirement A says, using the financial statement effects template, illustrate the effect of two separate dividend transactions, and use negative signs when appropriate. Okay, so how do we do this? Well, let's look up here at our scenario. And we've got a couple of other videos just made recently where we were dealing with dividends as they would pertain to common stock and cumulative preferred stock. All we have to deal with in this exercise is common stock. So Cheney Company has outstanding 25,000 shares of $10 par common stock, $10 par value common stock. It also has $405,000 of retained earnings. I'll come back to that in a moment. Near the current year end, the company declares and pays a cash dividend of $1.90 per share and declares and issues 4% stock dividend. The market price of the stock at the declaration date is $35 per share. So we have quite a few facts here. Notice in our little financial statements effects template down here, if you can read this, it's kind of hard to get on the page, but we've got declared and paid a cash dividend, and then declared and issued a stock dividend. So we're going to address these individually. But before we do, dividends are normal. I just want to say this: dividends are normally paid out of current earnings, and kind of the second step to that is so we have to have sufficient cash to pay the dividends. We have to have a formal approval by the board of directors, and then we usually have to have sufficient retained earnings. So $405,000 is kind of the magic number here. So we're going to bring over our calculator, and we've got 25,000 shares of common stock, and in the scenario it says they declared and pay a cash dividend of $1.90 per share. So they paid this $1.90 dividend on all 25,000 shares. So we're going to need to multiply this 25,000 shares outstanding by $1.90. And that's going to give us $47,500. The cash asset here is going down by $47,500. We paid it, and so therefore cash is going down. All right. Now, earned capital. This is part of essentially what we call retained earnings. Okay. So we've got some earnings. We said that dividends are normally paid out of earnings, and whatever is not paid out of earnings flows into retained earnings. Whatever is not paid out via dividends flows straight from the income statement to balance sheet. I'll get it out here in a minute. Okay, so our earned capital also is going to go down by that same $47,500, and that's really all we have to do here. Okay, so cash asset goes down by $47,500, and earned capital goes down by $47,500. I want to say one thing. Our earned capital went down by $47,500 as soon as the dividend was declared. Okay, as soon as the dividend was declared. Earned capital went down by 47.5. The cash asset did not go down by 47.5 until the dividend was actually paid. Okay, so minor point, but worth noting, because sometimes if there's a straddling the declaration date and the cash payment date are in two separate years, that's interesting. Okay, so how do we handle stock dividends? So stock dividends will impact the mix of owner's equity, but it will not ultimately change, okay, owner's equity whatsoever. So a 4% stock dividend. All right. Notice here that we have 25,000 shares. So we're going to plug this into our calculator. Oops, not 28. 25,000 shares. And so we're going to actually multiply this 25,000 times 4%, or 0.04. And if we do that, we get 1,000. So we've got 1,000 shares of stock that we're going to issue as a dividend. Okay. It also has some further information here that we have $35. The market price at the stock dividend declaration date is $35 per share. So we're going to multiply that by 35. All right. Okay. And so what we're going to do is we're going to subtract $35,000 directly from retained earnings. Let's see here. One more zero. There it is, 35,000. Okay, and that's fine. Contributed capital is going to go up by the same $35,000. However, I think it's worth mentioning, let me just move this out of the way for a second. I think it's worth mentioning that of this $35,000, okay, we have a $10,000 increase to common stock, which is simply, let's move this back up here, the 1,000 shares in the stock dividend times the par value of $10 gives us $10,000 increase to common stock. And then we also have a $25,000 increase to additional paid-in capital common stock. Okay, or just additional paid-in capital is fine. And that $25,000 is the difference between the $35,000, $35 times the 1,000 shares, right? So again, 25,000 times 4% times 4% is 1,000 times 35 gives us 35,000 minus basically $10 times 1,000. So minus 10,000 is 25,000. Okay, so this contributed capital would go up by 35,000, but it is in two separate pieces. Okay. All right. So then, with that said, let's look at the journal entries and how those would be handled here. And so this, I just want to say this. Oh gosh, dividends are a little bit strange. So when we pay out a dividend, you know, we really are going to probably have an account other than retained earnings that is going to go down. So you know, depending on the accounting software that you're using, your chart of accounts may be set up in one of two different ways. Recall that retained earnings has a normal credit balance similar to revenue. So this journal entry that I'm showing you is based more on what is actually going to happen at the end, whenever we pay this cash dividend. This is not necessarily a journal entry per se. We would, in reality, instead of actually debiting retained earnings, and I understand why your textbook might want you to do this, what we might actually be debiting instead would be something like owner withdrawal, owner draw, something like that. And then, so when we debit that other account, the owner withdrawals like that, owner draws, and then we credit cash, retained earnings is going to automatically go down by the amount of cash paid out, okay? But for our purposes here in the non-working accounting world, to illustrate this a little bit clearly, we're going to use retained earnings here. Okay, we don't normally make entries directly to retained earnings. That's not how it works. Okay, but anyway, 47.5, 47.5, and this is what would ultimately happen. Cash would go down by 47.5, and then retained earnings would go by the 47 down by the 47.5 in dividends that the business did not retain. Okay, all right, and then the other the other journal entry that we have here, we're going to kind of do the same thing. And this is a little bit more legitimate. Retained earnings is going to go down by the 35,000 for the stock dividend. Common stock is going to go up by 10,000, which we already did all of this right up here. And then we're going to say additional paid-in capital common stock is also going to increase by 25,000. So again, just as we can kind of illustrate right here with less detail, we can see that equity overall here is not impacted, but the mix of equity is impacted. All right, so that's a look at the journal entry, and this is probably the best view in my opinion because it separates these numbers out. And then finally post the journal entries from B to the related T accounts. Okay, well, easy enough. We've got cash as our first T account, and cash is going down. And we do that on the right because it is an asset account. Yeah, okay. And then so if we want to take this just in order, retained earnings is also involved, and so retained earnings again has a normal credit balance, so it goes down on the left, okay, because it has a normal credit balance. So I wrote a D on the left side to indicate that that's the normal balance there, and then a C on the right side. So it's going down. Goes down on the opposite side of the normal balance side. All right, and then we have the second transaction where retained earnings goes down another 35,000, and then common stock has a normal credit balance, so that $10,000 is going to go up on the right or on the credit side, and additional paid-in capital, again normal credit balance, so our remaining $25,000 will go up there. All right, that's it for this video.